The pressure on the American middle class, what many now call the working poor, is intensifying. Inflation has acted as an invisible tax, quietly eroding purchasing power. It was never truly temporary or transitory, despite what was once suggested. The reality is clear. Paper currencies are steadily losing value. Across the United States and Europe, there is a growing awareness of widening wealth inequality. We are witnessing what appears to be a slow, incremental currency reset, not dramatic or overnight, but gradual. Confidence in fiat currencies, especially the US dollar, as the world's reserve currency, is weakening. This debasement is not limited to the dollar. It affects all paper currencies, the euro, the yen, even relatively stronger currencies like the Swiss franc. When measured against hard assets, particularly gold and silver, fiat money continues to decline in absolute purchasing power. This concern is shared across income levels. Whether you're in the top 10% or the bottom 10%, the erosion of currency value affects you. Add to this geopolitical instability, political polarization, coalition governments lacking strong mandates, and deep distrust in institutions from central banks to political leaders, and the cracks in the system become more visible. In the US, political division between left and right has grown extreme. In Europe, leadership struggles reflect similar tensions. Across both regions, there is rising distrust toward media, policymakers, monetary authorities, and financial systems. Immigration pressures, debt expansion, and economic inequality further amplify instability. At the core of this turbulence is a debt crisis that has evolved into a currency crisis. Gold and silver rising sharply is not something to celebrate, it is a warning signal. When hard assets surge exponentially, it often reflects stress within the banking, credit, and monetary systems. It signals a potential turning point. History shows that excessive debt, monetary expansion, and inflation inevitably widen wealth gaps. They often lead to political centralization and systemic restructuring. Currency resets have happened before, sometimes gradually, sometimes abruptly. Today's shift is likely to be incremental and increasingly digital, intersecting with tokenization and evolving financial infrastructure. The distrust we see today, whether toward the dollar, euro, yuan, or political leadership, is part of a broader historical cycle. After decades of monetary expansion and debt growth, the US has moved from $248 billion in debt in the early 1970s to over $38 trillion today. That shift is not merely numerical, it is structural and historic. When the US left the gold standard in 1971, the dollar gained extraordinary flexibility. As John Connolly famously said, "It's our currency, but your problem." For decades, that statement held truth. The US could expand money supply, monetize debt, and export inflation globally because the dollar was the backbone of trade, oil markets, and global finance. But circumstances evolve. Massive debt accumulation and recent geopolitical events, including the weaponization of financial reserves, have accelerated global diversification away from the dollar. Central banks have increasingly reduced US Treasury holdings while increasing gold reserves. This shift is not coincidence. It reflects strategic repositioning. The dollar is not disappearing, but it is being repriced. The world is gradually deleveraging from overdependence on it. The petrodollar system is evolving. Trust, once abundant, is now conditional. Gold's exponential rise is less about speculation and more about recalibration, a market response to systemic debt and currency dill.